Yeah, so I bought a gym for $1 million, 200 grand under the asking price. Net income was about over 9% yield and 10.5% gross yield. Good deal. Hi, I'm Andrew Wright, Principal of Professional Southport, and this is the Andrew Wright Property Podcast. I've built a multi-million-dollar property portfolio, delivering a seven-figure annual rental income, and led my real estate team through thousands of sale and lease transactions. In each episode, I share real deals and strategies that will help you find, fund, and operate profitable property deals. The aim of this show is to provide education and build a community of like-minded investors who can collaborate, share insights, and help each other in each other's journeys. You can make excuses or you can make money, but you can't do both. So come and join us.
Hello and welcome back to the Andrew Wright Property Podcast. Now today we're unpacking why a gym with 2 units above is a powerful mixed-use play. 2 income streams, low vacancy risk, and a better bank appetite. We'll break down Andrew's Gatton purchase at $1 million and how he solved a lease option problem and how it's performing today. Andrew, welcome back to the podcast.
Adam, how you going?
I'm really well.
Listen, before we get started,
okay.
Is this Adidas or Adidas? How do you say it?
I say Adidas. What do you say?
I say Adidas, maybe because we're old. What about, is it Nike or Nike? What do you say?
Ooh, I think I've used both at different times. Yeah.
Bit of wasted gossip there.
Well, comment below. Tell us, how do they do that in the comment? How do they tell us what they say?
Yeah.
Nike, Adidas. We have a bit of fun with it. Fantastic. All right. So, 200 grand below asking?
Yeah, they initially were advertised at 1.3 million. So this property was, again, advertised online. Anyone could have bought it. 1.3 million they were asking.
Okay.
And been online for nearly 2 years, and they dropped the price to 1.2. So obviously everyone thought it was too expensive. It was, in real estate terms, we say a listing goes stale after a month or two. A couple of years is pretty stale.
A couple of years is a long time. Had you seen it earlier?
No.
Were you following it?
No.
But you look at every listing. How did you not know?
Well, it wasn't a new listing.
You look at new listings.
Yeah.
You get the
that was before I started my internal job description of looking at listings every day. That was 3 years ago now, and I'd only just started looking at all the new listings.
You know that people, you do realise you've created yourself a problem here, Andrew. just before we continue, okay? Anyone who's now been listening to this podcast knows you look at every single listing.
Yes.
On real,
it might only be a few seconds, but I'll just rule it out. But let me look at this.
You now
one.
know there's a whole group of people doing exactly the same thing, and you are probably going to be bidding against someone who's listening to this podcast at some particular stage.
Yeah, I'm sure it'll happen.
Okay, all right. So, do you get a notification if there's a price drop? Then, how did this come into your field of?
Well, no, I didn't know there was a price drop from the ad. It just said 1.2, but. As a real estate agent, I have a subscription to a thing called RP Data now, or Logic or Cotality. It's rebranded, and through there, as an agent, you can go through and have a look at all the advertising history. And I just went through, and as I do for every listing, and I went back and saw that it was advertised for 1.3. And when I rang the agent said, "Oh, look, Andrew, they wanted 1.3. They've dropped it to 1.2." So that's.
You did. Yeah. You went and did your research.
I did the research.
Saw it had been there for 2 years.
Yep. But what I want to say at the outfront, at the start of this podcast, is that at 1.2, this wasn't a fantastic deal. So when I say it's important to have a skill set of finding great deals when you're buying property, you don't always find great deals. You need to make them.
Yep.
Now the fact that I bought this at 1 million made it a great deal. At 1.2 million. I didn't find a great deal. I made it a good deal.
Right. Well, let's talk us through the negotiation then. So let's set the scene. You've found this thing. It's they're asking 1.2 now. You know that they've just dropped from 1.3. You know it's been there for 2 years. Talk us through the negotiation and your thoughts and how you approach this, because this is going to be huge for people to understand the skills involved in. Essentially, what's that, a 16% drop? I think it works out to be. Is that
well,
about
1.3 to 1 is 30%.
So it is.
Yeah. So it's not 30% actually. I can't do the numbers either, but it's high 20s or something like that. But look, at the end of the day, again, there was some sort of emotional thing there. I went to school in Ipswich, so I bought property in Ipswich. I was born in Hervey Bay. I bought property in Hervey Bay. I went to Gatton Agricultural College when I left Ipswich Grammar School, and even though it's a small regional city, which some may suggest implies a higher vacancy risk or something like that, I knew the city pretty well. And when you know a city well, you know people there, you've been there, you've lived there, it sort of, I guess, brings you into some sort of comfort zone that it takes away a little bit of fear. So I had the mindset of, I wouldn't mind buying a property there. It's in the main street of town, Railway Street. If I don't get it, I don't care. I'll buy something else, but I'll put it in an offer. So I offered him $950, and the agent said no, and came back a few days later and sort of wrote me off as just not a serious buyer. I chased him. He said no, they won't sell for $950, and I sort of left it at that. And then I let it go for a few more. I said, hey, listen, will they take $1 million? Oh, I don't think so, Andrew. We'll give it a crack. And came back on the phone. Look, Andrew, I'm happy to say owners' circumstances have changed. They've been trying for 2 years to sell this one. They're going to take your offer. And I just said, oh, wow, great. Let's have a crack. So, again, by making an offer, and another part of my job description that I haven't spoken to you about is I do try as a KPI, if you like, to make 1 or 2 offers every month on a property. And that was one of them, was like, I'll put an offer in, probably nothing will come of it, but I'll give it a crack. And because I went through the process and was disciplined to make an offer that wasn't accepted at $950, a week later I did a deal at $1 million.
Right.
The rent at that stage, gross rent $105,000, so there's $70,000 from the gym downstairs, $35,000 upstairs from the 2 residential leases, $105,000 on $1 million. That's 10.5% gross yield, about 9% net, and I'm borrowing at 6%. No brainer.
Yep. So numbers stacked up at $1 million. What would you have gone to, or was that it?
I might have paid an extra $1,025,000.
Yep. So only a little bit more.
Yeah, a little bit more. I mean, when you're buying in a regional setting, that there is a little bit more risk. You want to get a higher yield to compensate you for that risk. Mm-hmm. You don't get 9% net in Brisbane or the Gold Coast or Sydney. It doesn't exist. If you're going out to a regional area, you need the higher yield to compensate you for the extra risk. But I knew, like, the residential-wise is very low risk in that area, like most others. It was easy to find a tenant.
Well, I was going to say, what were the leases?
The leases were this is another thing. Good point. Good question, I should say. The leases upstairs were under rented. So the tenant in the 1-bedroom apartment upstairs was only paying $280 a week, and the 2-bedder for a 2-bedroom apartment, they're only paying $400 a week. Now I thought, well, gee, I can increase those rents. And now the 2-bedder, I've gone from $400 to $480, extra $80. I'm not ripping them off. That's just fair. They weren't paying enough before. Yep. The 2-bedder's gone from $285 now paying $280 now paying $315, an extra $35 a week. But between the two there, that's an extra $115 a week rent, $5,000 a year. And the downstairs, the gym, the rent has been indexed to CPI. They're paying an extra $5,000 now, from 70 to 75.
Yep.
Total income about $117,000 a year on that $1 million now, which is nearly 12%.
And so the residential, they would have been on 12 months.
6 months.
Right.
One was 6, one was 12, but now they're on 12-month leases each, and they've just
the gym?
renewed. The gym had been there a long time, but they had a 3-year lease with a 3-year option, 2 3-year options. And when I went through the due diligence period, I actually asked the agent to confirm that they'd actually exercised their option. And the agent, of course, they've exercised the option. I said, well, can you give me proof of that? well, no, I can't. So I write to the sellers and say, can you please provide evidence that the tenant has validly exercised their option as accordance to your lease? And this is part of the due diligence. Oh, no, we can't, Andrew. It wasn't validly exercised. Oh, okay, so the agent wasn't telling the truth. Okay. So as part of the due diligence, to protect me, I didn't want the gym moving out straight away.
Yep.
I said, look, I will satisfy this due diligence clause if you enter into the lawyers called it a deed of extension.
Right.
So that the owner of the property and the tenant both agree to continue as if they had validly exercised the option to extend the lease for another 3 years. So that provided me certainty that the tenant was locked in for another 3 years and couldn't move out tomorrow.
Right.
And on that basis,
you were willing to move ahead.
Yes, correct.
Okay. So you went into this one just purely on the numbers then. The numbers stacked up. There wasn't a plan to change the
couldn't add value.
There was no way to add value.
No, it wasn't a property development deal or a value add deal. It was just a good deal.
Good deal based on the numbers.
I made it a good deal.
Yep.
Yeah.
And that's what you've done here by making that lower offer. And what do you know? Interestingly, do you know what the change in seller circumstances was? You said that the agent said the seller's had a change of circumstance. He's going to take you at the mill.
Well, the very limited information I got again was, a bit of a health turn, elderly wanting to retire, so just became more motivated. But it's not like from the other side of the coin. I don't want viewers to think, I'm taking advantage of someone. Look, this was advertised for 2 years. Those people paid $500,000 or $600,000 for the property 10 years earlier. They doubled their money. They needed some money in their lives for whatever. No one else wanted to buy the thing. It's a win-win as far as I'm concerned. And remember also, the first 3 properties I bought myself, I lost money on.
Yep.
So in a market, sometimes there'll be winners and losers.
Yep.
And the more skills you got, hopefully you have more winners and losers.
Well, look, I want to do an episode on those 3 properties at one particular point and where that did go wrong. And because we want to do with episodes here about people learning, and you can learn probably even more from where you lose money than when you make it. So we will delve into that one at some point. So did knowing what you did, and for listeners who have listened to the whole series, we did do a really good episode on what you did with a retail space, and then in Southport, and then turned the upstairs of that into residential. So you had experience with that asset mix.
Yep.
Did that play a role in you having confidence in going ahead with this deal?
Yeah, it did.
Do you think that's a really good mix, and why?
Yeah, I think it is a good mix. I mean, the Southport one was a rooming accommodation, boarding house situation, whereas this one is renting out the whole full apartments, 2 separate apartments.
Yep.
So a little bit different, but basically resi on top and retail below. I think it's a good mix because it's just, there's 3 incomes in that property, which is a diversification of tenants, but it's also a diversification in the type of income. So you got residential and then you got retail. So I think it's just it lowers the risk profile of the asset, one having 3 tenants instead of 1, and also having 2 different asset types. The thing I like about the mix also is that the gym on the bottom floor hadn't just moved in there. They'd been there a long time. And look, if you've got any type of business and those customers need to come to your business like a gym, it's a 24-hour gym, over a period of 10 years, you develop, the valuers call it goodwill. Like, it's not easy to move that business somewhere else because people don't know where you're gone to, or it's convenient for them to go there.
That's
so
right.
If you get a tenant that's been there 10 years, they're probably not wanting to move as long as that they don't outgrow the size of the place or something. They're going to want to stay there. So that gave me a fair bit of confidence that that tenant would want to stay there a long time.
For sure. And Gatton being not a huge place,
there wouldn't be many other places to move it.
That's right. And if it's on the main street and everything, it's sort of a prime location, where everyone in the area can get to. So you probably thought about all of that in that as well.
And you think about a gym, all those weights and stuff. Can you imagine having to move it all? Like all the equipment, the leg presses, the squat racks. I mean, it'd be really expensive to move all that equipment and start up elsewhere.
This sort of has given me another question that's come to mind as we've gone through this series, Andrew. It seems most of your, if not, well, no, most, we'll call it most, of your deals are outside big metropolitan cities. Now, you look at every listing, which would include metropolitan cities, but you're just finding that the numbers are better outside. Is that right?
In recent years, yes. So, like, I bought a residence on Sovereign Island on the Gold Coast 20 years ago. I bought a couple of offices in Southport 20 years ago. I still hold them. And then I bought 36 Nerang Street, a retail and boarding house property in 2018 or something, like 6 or 7 years ago. So I bought my wife a penthouse on the Gold Coast as well when we separated. Like I still got property on the Gold Coast, but the last 5 years, yes, when I look online, I don't see the value there anymore. And it's continued to go up, and maybe I'm wrong. Maybe I should have bought more on the Gold Coast, but from a long-term capacity to hold property, the net returns of Gold Coast property, just at the moment, in my opinion, it's just very, very hard to be able to scale a portfolio because you're negatively gearing them.
Yep.
Even like the commercial ones that I gloat about, you know, you're getting 4 or 5% return on the Gold Coast. Interest rates are 6 or 6.5. You're losing money unless you're putting a 50% deposit down. So at the moment, my preference is major regional areas. But, you know, if I had $100 million, I might buy in metro areas. And I'm not saying that's not right for other investors. But for me, I'm trying to find things that actually make money, that provide higher than 6% income, because I'm borrowing money at 6%. I'm not paying cash. If I could pay cash into a boring service station or a childcare and get 4 or 5%, you know, maybe I'd be interested. But I don't have $100 million in cash lying around to do it. So I'm chasing better returns and accepting slightly higher risk to do so.
Well, that brings me to, I always ask, how did you finance this deal?
40% deposit bank. So because I had the resi upstairs and the gym downstairs, I was able to get, once again, it wasn't a full doc loan, it was a lease doc loan on that one. So I just had to come up, I can't remember if it was 30% or 40% on that one. I dragged out a bit of money from that Ipswich deal that I revalued. I remember I got $1 million uplift there from spending $350, and that extra $650 there, I was able to redraw a fair bit of money from that one to go and buy.
So redrawing is part of your overall strategy, isn't it, to build the bigger portfolio so that you can continue to come up with those deposits, take on a better deal. And, you know, I'd assume this one you're looking at some capital growth in its valuation, so you can do the same thing for one of your next ones.
Yeah, look, what you never really know what sort of how much equity you bought in a property unless you sell it. You know, I thought that property was, you know, going to value up all day long at 1.2, 1.25. Immediately after I bought that one, there were a couple of other sales in the same street at really, really high prices. I thought, wow, value is going to give this 1.25 to 1.3. Came in at $1,150,000. Only a year later, I revalued. It only went up 150 on the valuation. I completely disagree with the valuation, but at least I was able to grab $100,000 out of that. To go and
finance the next one
up in Harvey Bay. That helped for a little bit of the deposit for the sheds in Harvey Bay.
The sheds in Harvey Bay, which was our last episode. If you want to find out about cold storage and industrial sheds, do check out that one, because that was a cracking deal. And look, while we're on that point, Andrew, you've got a checklist for people to use when they're getting into commercial investments, which most people probably haven't considered yet. And so do jump onto Andrew's website, www.andrewwrightproperty.com.au. Download that. It's absolutely free. And we'll talk you through what Andrew looks at and has a checklist to know whether it's, going to stack up and be a good deal or not. So, but look, before we finish on this one, mate, anything go wrong with it? Is this just a standard good deal? Then you put in an offer that was well below asking, you got it, you had a good deal.
For the main, just a good deal. There was a couple of little problems. I had a couple of little roof leaks there. I think I spent $6 or $7 grand in maintenance there at one stage getting roofers up there. But for the most part, I haven't had any problems. The gym tenant has just signed, and we're 3 years down the track now, and they've just signed or exercised their option to extend for another 3 years.
Okay.
So, it's just looking like just leave it there and let it do its thing now. It's good, and hopefully I will revalue that again in another year or so, and hopefully it'll value up a little bit higher and I can redo a little bit more extra out of it. But one lesson I want to make sure people get out of this is that you don't just find great deals, you've got to make them happen. Now, if they had advertised that at $1 million with 105 grand rent, it would have sold 100 times over. But it wasn't. You couldn't just find that deal for $1 million. You had to make the deal.
Yep.
It was advertised at 1.2, and at that price, it wasn't the best buy of the year, but I made the deal happen. And I don't know, do you understand my point? You can't just find good deals, you've got to make them happen. If you're not making offers, you won't find a lot of these deals.
Absolutely. And look, that brings me to a point. I think, I understand that this really is your passion, this, doing property investing, and even more so doing this podcast to share your knowledge with others. So can I ask you, if there's listeners out there who have joined your community and your mailing list, and they've got questions or they've got a deal on the table that they'd like some advice on, are you happy to take those emails and respond and give them your advice?
Yeah, look, I love doing this. It honestly, it's fun for me looking at deals, and within 5 minutes, I can say, yeah, it's a goer, or maybe it's a goer. You got to check out X, Y, Z first, or no, this is it's in a flood
hang on,
zone.
there's a red flag there that I'd be looking at. So, look, that huge. If you're out there and you're listening, and you do have a deal you're looking at, and you want some advice, reach out to Andrew, send him an email. You can contact him through Professional Southport as well. So this is about a community. It's about people getting together and helping each other out. So please do reach out. Now, I've got two final questions. One, 2011, didn't Gatton get absolutely smashed by a flood?
When did I go to Gatton?
Was that one of the towns that got absolutely smashed?
To 1991, I went to
or have I got
college
it
there. I honestly don't know. I honestly don't know. But it's not in that particular area is definitely not in a flood zone, because I looked on the flood map.
Okay.
So part of Gatton may have, but I think I
remember. You remember the big floods of 2011, where you're seeing people on roofs and that.
Yeah, part of Gatton was affected.
Yeah, but look, so was Toowoomba.
Yeah.
So anyway, I just wondered whether that had come to mind.
That property hadn't flooded. Believe it or not, there was actually a major fire at that property, and that property was damaged by a fire. The place next door actually got completely taken away because there was a big fire there. So even now today, there's some black marks on the outside of the bricks of this property as part of the history there, but no flood incident.
Final question, which I think is probably a big one for a lot of listeners out there. Now, in both this episode and the last episode, you've talked about unexpected expenses. You talked about 6 or 7 for this one for a couple of leaks in the roof, did you say?
Yeah.
And there was 46 grand in your last one, I believe, for some refurbishment of the cooling equipment.
Condensers and evaporators, yeah.
Now, if there are people listening here and they're looking at, a strategy like you moving from a residential, now, obviously, you've still got to have a kitty for the residential property, floods or new carpets or, whatever, but probably not to the extent you're talking of 46. What's your advice on what you need to have in available liquid funds to be able to deal with, let's call it a 46K expense? Now, that's probably scaring a lot of people. I can finance this deal, and I've got a bit in the bank, but I don't have 46K I can just drop if suddenly I need to fix some fridges.
Okay, great point, Adam. Look, I'll share with you something that the answer will probably surprise you a lot. I have bought that much property this year. I've bought 7. I don't actually have the 46 to fix. I don't have it.
Well,
I don't have
where did you get it from, Andrew?
I asked the tenant to pay for it, and I've told them that I'll give them a rent credit for the next. They pay $7,000 and something a month. I'm giving them a credit. I said, you want this fixed? They didn't just want it fixed. They wanted it. One of them, a couple of them, they actually wanted upgrading. So the cold storage facility actually had a certain, cold temperature, and they wanted to make it more colder. So they didn't just want to fix what was there. They wanted to upgrade. I said, well, you want to upgrade it, but I'm not upgrading your rent. 1, you better sign a new lease with me. And 2, you pay for it and I'll give you a rent credit. And they said, okay. So
it's thinking outside the square.
That's a bit embarrassing. Look, you should have a buffer, and I'm not saying that's the way to do it. But in that case, because I've spent all my money buying all these properties, I didn't actually have enough buffer to cover that. So I got the tenant to pay for it. I'll give them a credit for the next $7,500 divided by 46. What's that? I don't know, however months, 6 months or whatever it is, they won't be paying me rent because they're going to pay that bill for me.
Okay.
So I got to.
But overall, you would need a much more of a buffer of
yeah, you do. So it depends on the asset
to cover.
So it depends on the
problems.
asset. So if it's just a normal shed, you don't need to have a big buffer there. If you got long leases,
if it's a truck parking outside,
if it's an outdoor store, you don't need it.
Not much can go wrong.
For a house or for retail property or an office, you're probably going to have to put more money aside, or be working hard in your business with good cash flow to be able to come up with money when you need to. I run the gauntlet there. I'm probably not a great example setter on keeping enough cash buffers. There's a guy in America called Grant Cardone. He always keeps himself broke, and it forces you to work hard every day. I'm under pressure. I've got all these bills. My credit cards are always being used for various business and stuff. I'm always redlining it. But guess what? I'm motivated every day to work because I'm under pressure.
Love it.
Most people probably shouldn't operate like that, but that's motivated me to go out and work hard. I always redline it.
Love it. Fantastic.
Don't listen to me about cash buffers. Go and see a financial advisor or accountant. You should keep a cash buffer.
In no way can this be construed as financial
advice.
That's advice. Please always read the terms. No.
Yes, well, it's true.
Fantastic. Look, I'm loving this podcast, and I'm sure our listeners are as well. So please do hit follow so you don't miss any episode wherever you listen or on YouTube. Please do jump into andrewwrightproperty.com.au. Join the community, and look, give us a rating. Please share this podcast that you can help us grow this and grow our community. We will be creating Facebook groups and things where this really does become a collaboration of like-minded people who, share the same passion as Andrew does, and want to share some advice and potentially even do deals together. Who knows? Who knows? So. Andrew, once again, thanks so much, and really look forward to the next episode.
Thanks, Adam. Appreciate it. Thanks for listening to the Andrew Wright Property Podcast. This is all about building a community of like-minded investors who can share real-life stories, experiences, and collaborate with a view to helping each other. Join us. Get in touch through the link in the show notes. I look forward to you joining me on the next episode.